All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Tuesday, everybody. Today is July 8th, 2025. And the top story this morning is long duration bonds are selling off. It's not a brutal sell-off. The bond market isn't crashing, but bonds are selling off. They're moving lower. Interest rates are moving higher. What is going on? It's happening in the United States. U.S. 10-year yield up about 4 basis points this morning. Well, what happened in the U.S.? We had the big, beautiful bill passed. We're raising the debt ceiling by $5 trillion. There's going to be a surge of new issuance. The Treasury is going to refill Uncle Sam's checking account, the Treasury general account, which usually happens right after the debt ceiling gets raised. In other words, there's going to be a lot of new bonds issued. What's happening in Japan? There's worries in Japan this morning. The 10-year Japanese government bond, the 40-year, up 10 basis points this morning. Well, they're worried about higher spending. They're worried about potential tax cuts. There's an election going on in Japan this morning, and it doesn't matter who wins in Japan. The net result is going to be more borrowing. You've got one side in this election that's coming up in the next few months is saying we want to make all these promises, free stuff for everybody. The other side says we want to cut taxes. Both sides are going to increase government borrowing. And in Japan, who's the only person lending to the government long-term? It's the Bank of Japan. They're basically the entirety of the market for long-term Japanese government bonds. And if there's going to be more supply, but the demand stays the same, then the price is going to go lower and the interest rate is going to go higher. Same thing is happening in the UK this morning. The 10-year gilt is up another 7 basis points. We were talking about the UK bond market last week when the Chancellor of the Exchequer, Rachel Reeves, was crying in Parliament because the Prime Minister was dodging questions about whether or not he was going to fire her. The bond market freaked out on that story, and then Keir Starmer had to come in and say, no, we're not going to fire her. And the UK bond market did kind of calm down a little bit there, but now we're back near the highs from that day. Interest rates in the UK are continuing to rise. So what's going on? What do all three of these stories have in common? They're all about new issuance. They're concerns of new issuance, supply worries. In other words, the governments are borrowing too much freaking money, and it's not just an America problem. It's happening everywhere. And you think maybe, just maybe, this has something to do with the fact that gold is at an all-time high, with the fact that silver is trading in the high 30s, probably headed back towards all-time highs, with Bitcoin at all-time highs, stocks at all-time highs, real estate hovering near all-time highs. Everything is near an all-time high. Is the economy that great? No, it's not. You know what's not near an all-time high? Bonds. Bonds are going lower and interest rates are going higher. And when you think about it, what is a bond? A bond is money tomorrow. That's all a bond is. And money tomorrow is going down in value while everything today is at an all-time high. In other words, inflation is coming back because what's not being said and what we all know is coming is sooner or later, these governments will run out of other people's money to borrow and spend. And the central banks are going to come in and they're going to print that money into existence and loan it to the governments. And that is what the markets can see. And that's why everything just keeps going up. And that's why bonds are going down this morning. Got to get the spending under control. Of course, that's not going to happen. And that's why I just keep saying none of us owns enough gold for what's coming. Meanwhile, tariff talk is back this morning. The tariff letters went out yesterday. President Trump sent his letters to our trading partners. The rates that were in those letters largely mirrored the rates that were released on the placards on Liberation Day. Some of them went up or down a couple of points, but for the most part, they were identical rates. There was, as expected, the effective date of August 1st was included on those letters. So in effect, it was a 3-week delay in the return to Liberation Day tariffs with some exceptions. Also, President Trump indicated yesterday that he may be somewhat flexible about that August 1st deadline. So depending on your opinion here, is this, more a return to Liberation Day madness, or is this an extension of the taco trade? Either way, the market, they were down on this news yesterday, but the market certainly didn't overreact to these tariff letters going out. So my opinion, the market is still downplaying the risk of tariffs, and I think that's a mistake here. Another story going on this morning, China's car sales in June are booming and a record high. So is the economy in China doing so great? Hey, look at all the cars we're selling. Well, no, it's not really booming. Why are car sales booming in China? Two reasons. Number one, the government subsidized car sales. The Chinese had their version of cash for clunkers, up to $3,000 to help you buy a new car. And number two, Chinese automakers are not making money. They've been deep discounting their vehicles. At the same time, they have been not paying their vendors, something that the Chinese automakers were basically hauled in front of the government to explain themselves a few weeks ago. And so I'm not surprised that these car sales are hitting all-time highs or hitting records because the government is paying for it and the people building the cars are paying for it by not paying their bills. So it's not really a sign of prosperity. It's a sign of the deflationary crisis and all the hoops they're having to go through to maintain consumption levels in that country. Another story going on this morning, Link2 has filed for bankruptcy. Now, you guys may not be too familiar with Link2. They're a company, they were all the rage a couple of years ago because Link2 was an online exchange where you could go buy shares of companies that were not publicly traded. You could buy private shares. If you've been on CNBC in the last 3 or 4 years, then you've almost certainly seen ads for Link2 where they advertise, oh, you can buy Anthropic shares, even though Anthropic had never IPO'd. So wait, there is no shares of Anthropic. How can you buy Anthropic shares? Well, because they were basically selling tokenized shares of private companies. And, well, in a shocking turn of events, they were full of it. Turns out investors never really owned what they thought they owned. All they owned was an IOU from somebody who it looks like was a criminal. We don't know that for sure, but the company filed for bankruptcy, and there are worries that the CEO may have up and sold all the stakes in the companies that investors thought they owned, leaving those investors with nothing but an IOU from him. People have been locked out of their accounts. Their money is pretty much gone. We don't know if they're going to get any of it back. That's up to a bankruptcy court to decide, and chances are rich people's lawyers are better than yours if you bought those shares. And, well, that money's gone. And the reason I mentioned Link2, besides the fact that that bankruptcy is happening this morning, is because Robinhood is being hauled in front of regulators to answer questions about tokenized shares of OpenAI and tokenized shares of SpaceX. In other words, the same freaking story. Robinhood, we talked yesterday or last week about how Robinhood issued shares of SpaceX and issued shares of OpenAI. They were doing this giveaway to promote their new tokenized shares that were going to be available in Europe. And OpenAI comes out and says, no, that's not our company stock. We didn't authorize this. I don't know what you're buying, but it's not our stock. In other words, you're just buying an IOU with paragraphs and paragraphs of legalese to protect Robinhood's butt. And who knows what's actually behind that investment? Well, the regulators have some questions in Europe about that issue, right as Link2 is filing for bankruptcy. And if you're seeing any similarity between these two stories, well, then surely that's just coincidental, right? And don't call me Shirley. And last but not least, we got another ship was attacked in the Red Sea this morning. I should say is being attacked. The last I saw, the attack was still underway. This time it looks like casualties. Houthi and the Blowfish are at it again. Is the U.S. Navy going to get involved again? We just pulled out of the Red Sea. I doubt it. So it looks like global trade is going to get more expensive once again. Guys, we got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's happening in markets? And hey, this is when I usually say, hit that like button for the algorithm. And if you're new here, hit subscribe and come on back tomorrow and have your coffee with the melon heads because we do this every single morning. And right now, the S&P 500 is clinging to gains here. We're higher by about 8 points or 0.12% in the green for the S&P 500. The Dow, meanwhile, is down about 0.1%. or about 45 points, largely unchanged. And the NASDAQ is in positive territory, up 69 points or 0.3%. So stocks are mixed this morning with a slight bias to the upside. Looking over at the US dollar, we are a little bit higher this morning, but trending down 97.62. That's up by about 6 basis points, but not a lot happening on the DXY this morning. I have 2 Dixie windows open for some reason. Well, look at that. That's totally different looking because it's on a different time frame. Well, there we go. All right. Moving on. Let's talk about commodities. We typically do bonds first, but we're going to do commodities first this morning because we got a lot to talk about with bonds. But right now, spot gold is down a little bit here. $3,320 for spot gold. That's down about $16 or 0.5% lower. Spot silver is also lower by 0.5% or 17 cents at $36.60. But I like the shiny. Copper is lower by 0.2%. Platinum is lower by 0.13%. Palladium's a little bit higher here, 0.8% higher. That's the only green I'm seeing today. And crude oil is down by a quarter, about 0.37% lower, $67.68 for August WTI futures. And let's touch on Bitcoin real quick here. $108,863 for Bitcoin is priced on Coinbase. That's about $600 higher than yesterday. Some interesting news in Bitcoin this morning, in that there is no news in Bitcoin this morning, and that's the news. Check out this one in MarketWatch. MicroStrategy didn't buy more Bitcoin for the first time in 3 months. MicroStrategy has acquired more than 69,000 Bitcoins since it last took a break to bring its total holdings to nearly 600,000 Bitcoins. It's now bigger news when MicroStrategy doesn't buy any Bitcoin than when it does. The self-proclaimed largest Bitcoin Treasury company, which is technically still a software company, laughably, disclosed on Monday that it didn't acquire any Bitcoin during the week of June 30th to July 6th. This is the first week MicroStrategy, which is doing business as Strategy now, didn't acquire any Bitcoin since the week of March 31st to April 6th. So I don't know what phase it is in the crypto cycle when it's news that a Bitcoin treasury company didn't buy any Bitcoin last week, but that kind of stuck out at me. It's odd, and it just draws attention to the point that Michael Saylor's infinite money glitch has been running rather wild for the last few months. And guys, at some point between now and October, we're probably going to see the onset of crypto winter. So the Starks are always right. Eventually, winter is coming. Be careful on leverage in crypto. All right, now let's look at the bond market here. Not a huge move this morning. We're looking at U.S. Treasuries. The 30-year yield is higher by about 3 basis points, 4.958. The 10-year is at 4.423, also higher by about 3 points. The 2 years at 3.913, higher by 1 point, and the 1 month is actually lower by a point at 4.305. But what I really want to look at here is the longer-term chart of U.S. Treasuries. This is the 10-year yield going back to about the start of the year. And what I want to point out is since the beginning of July, all right, and the beginning of July is important because that's the start of the second half of the year, we have seen yields go up for now, 5 days in a row. Last time that happened was April. Now, these are not huge moves happening in U.S. Treasuries, but they are steady and consistent, indicating a shift in investor sentiment that coincided with the new quarter, with the new half of the year. And that is somewhat interesting here. And it's not just happening in the U.S. We're a little bit higher this morning, but look at Japan. And a lot of people are saying Japan is driving this move. Look at what Japan has done. Same time horizon, pretty much since the start of the year, since the beginning of July. Japanese yields, this is their 40-year JGB, have pretty much gone straight up. Not massive moves, right? Nothing like we saw in April, like nothing like the hysteria we got around Liberation Day, but a steady move higher in Japanese government bonds. So let's look a little bit about what's going on this morning in the bond market. Treasuries fall with global bonds as Japan's supply jitters return. When you hear about supply jitters in the bond market, that means there's a lot of borrowing coming. There's going to be too much supply issued. In other words, too much government spending or not enough government tax collection. More government debt is coming. U.S. Treasuries fell, caught up in a global sell-off of longer maturity bonds as concerned Japan may boost debt sales rippled across markets. The rate on the 10-year U.S. notes increased by 4 basis points to 4.42% on Tuesday, poised for the longest upward streak since April. The sell-off was most pronounced for debt due many years from now, with the 30-year yield headed back towards 5%, ahead of a government sale of longer-dated debt later this week. The yield on similar maturity Japanese bonds approached a record, while the equivalent German rate hit its highest since March. The supply concern-driven steepening of Japanese government bonds appears to be responsible for the move higher in the Bund, that's a German bond, and U.S. Treasury yields this morning, said Lynn Graham-Taylor, a strategist at Rabobank. Long bonds are suffering globally as many of the traditional buyers withdraw from the market as supply expands. Such securities tend to attract a smaller pool of investors due to their greater interest rate risk, with moves often exacerbated by lower liquidity, not things you want to hear about in the bond market. British and Japanese bond markets have proved particularly vulnerable, prompting their respective debt offices to cut their sales of long bonds. Last week, gilts sold off rapidly on concerns about the nation's fiscal outlook. This week, Japan is in focus. Investors are nervous. Politicians may promise more fiscal spending in the run-up to July 20th elections in the upper house. The vote may hinge on whether voters prefer ruling Liberal Democratic Party's cash handouts to the opposition's plan for lower taxes. Either way, that means the nation's super long bonds extended their recent declines Tuesday, pushing the yield on 30-year securities towards a record high. The yield on the 30-year maturity is above 3% and within striking distance of the peak set in May. And again, it's not just in Japan and in the U.S. We're seeing the same thing in the U.K. Similar time frame going back to the start of the year, daily candles. Now, it's a little noisier, but again, we're looking since the start of July in the UK. You can see, we have a little bias to the upside. Now, what you're seeing here, you've got this big candle, this one, right? This was when Rachel Reeves was crying in Parliament. This was the big blow up over all the spending cuts being stripped out of the welfare bill that the UK just passed. The bond market freaked out on that day. Keir Starmer managed to restore calm by saying, no, I'm not going to fire Rachel Reeves. But you may notice once that initial hysteria wore off, you can see that the UK 10-year gilt has resumed higher. The yield has resumed higher, meaning they're still selling off that bond. So again, you've got supply concerns in the UK as well. And you've got a little bit of demand concern as well. UK faces £22 billion hit as pension fund gilt buying wanes. Pensions are not buying the government debt here. Britain is at risk of £22 billion, that's about $30 billion, of surge in government debt interest bills as pension schemes buy fewer gilts, that's the nickname for their long-term bonds, making the country heavily dependent on foreign investors to snap up public debt. That's according to the UK fiscal watchdog, which said that a shift from defined benefit pensions to defined contribution programs will reduce an important source of demand for government debt, pushing up borrowing costs for the Treasury. So look, that we've kind of seen this over the last decade or so. Companies across the world are moving away from pensions and more towards contribution programs, more towards 401ks versus a pension. Those companies that still have pensions, they're suffocating under the weight of them. It's happening in the UK as well. But since people are moving away from those pensions, that means those pension funds aren't getting new money, which would historically go into government debt, which means there's fewer borrowers for government debt, which means the demand is down, supply's going up. That means the price goes down and the interest rates go up along with it. With the Bank of England also reversing its gilt purchases made under quantitative easing, the shift in pension schemes leaves the government reliant on overseas investors to buy UK debt at a moment of brittle sentiment. Brittle sentiment, that can't be good. These investors are more fickle and flighty, said OBR Chair Richard Hughes, who warned that the wider public finances are on an unsustainable footing. So apparently OBR Chair Richard Hughes has quite a thesaurus because he's worried about brittle sentiment, fickle and flighty investors. The UK cannot afford the array of promises that it has made to the public if you leave those unchanged based on a reasonable assumption about growth rates in the economy and in tax revenues, Hughes told the press conference. We look less resilient to those risks than similar advanced economies that have put their public finances in a more sustainable position. I don't know who those similar advanced economies are with their public finances in a more sustainable position. I'd love to meet this mythical government with all this responsibility. But what's happening in the UK is not unique. The same thing is happening here in the States. We're just borrowing too much. We're spending too much, and the bond market can't easily absorb this. So where is all of this going eventually? Sooner or later, the bond market is going to freak out. It's going to run out of other people's money, and the central banks are going to have to print it. They've shown us time and time again that's what they do. They will step up to inject liquidity, shore up a functioning, healthy bond market, whatever language they use to spin it. It's money printing at the end of the day, and that's where we're heading, and that's why everything is at an all-time high. Meanwhile, the trade war, that's still a thing. Trump issues new tariff rates, still open to negotiations. This was yesterday. President Trump unveiled a wave of letters, again threatening key trading partners with high tariff rates, even as he delayed the increased duties until August 1st and suggested that he was still open to negotiations. Trump posted letters to various nations on social media on Monday, starting with his intent to impose 25% levies on goods from Japan and South Korea. A dozen more followed throughout the afternoon, outlining plans to tariff goods from trading partners including South Africa, Indonesia, Thailand, and Cambodia. Later at the White House, Trump signed an executive order that further delayed the so-called reciprocal tariffs, effectively buying each affected nation an extra 3 weeks to cut a deal He said, for the most part, he was content to simply impose those duties, even as he indicated he was continuing negotiations. Still, the U.S. president said the August 1st deadline was not 100% firm and signaled he might tweak the rates further, maybe adjust a little bit, depending, Trump said, indicating he would look favorably on countries continuing to offer additional concessions. We're not going to be unfair. Well, it's good that he's not going to be unfair. But one thing the market definitely did not get from this was certainty, because when you say, oh, here's what our rates are going to be, but another 3-week delay, and we're flexible on that delay, I might tweak them a bit, but I'm open to negotiations. None of this is certain. Market's getting no certainty whatsoever here. So look, tariffs remains a big issue. Is August 1st going to get here? And then he's just going to say, you know what, 3 more weeks or another month. Maybe that's the taco trade. The market seems to think that's what's going to happen. I guess we're just going to have to wait another 3 weeks to find out. Meanwhile, China's June car sales hit a record for the month on a subsidy boost. They're doing everything they can to juke consumer demand in China. June is typically a slow period for car sales in China as the warmer weather kicks in, but last month bucked that trend, with buyers seeking to take advantage of a government trade-in subsidy before it was suspended in key cities, pushing the transactions to a record. Retail vehicle sales touched 2.1 million in June. That's a 7% increase from the previous June peak of 1.9 million in 2022. China's Passenger Car Association said on Tuesday, wholesale and production figures also hit record highs for the month. The strong growth during the traditional off-peak season shows that the trade-in subsidy, which provided about 20,000 yuan, that's $2,800, of rebates for newer car models, made a large contribution to domestic consumption, the PCA said. Some 70% of personal car purchases utilized the sweetener. In mid-June, some provinces, including Guangdong, Henan, and Zhejiang, did I say that right, stalled the program ahead of its planned end in December as funds ran short. Would-be buyers hearing that news may have been prompted to make their car purchases even quicker. The intensity of price cuts and promotions this year has also reduced greatly, particularly over the last 2 months, PCA said. Another factor that could have spurred consumers to get in faster. Only 14 new energy vehicle models had their sticker price discounted in June. Discounts were deeper for regular combustion engine cars. The practice of heavy discounting has garnered greater scrutiny, with officials convening a meeting of major electric vehicle makers last month to warn against unreasonable price cuts. PCA forecasts that automakers will continue striving to keep prices stable over the rest of the year by maintaining a steady rhythm of production, it said on Tuesday. So there's a lot of factors here. You got the subsidies from the government, and then they announced those subsidies were starting to go away. So a lot of people scrambled to get in before that happened. And you had those deep discounts, those big price cuts that was largely at the expense of not paying their parts vendors. The Chinese government started to crack down on that, indicating those discounts might be going away. So people flooded into the market to buy before that happened as well. In other words, I don't expect these China car sales figures to persist for much longer. Realistically, this is just a function of some pretty impressive efforts to move those cars. Let's put it that way. Also going on this morning, watch out for this one, guys. Once popular pre-IPO investing platform Link2 files for bankruptcy. Maybe this isn't the story you need to watch out for because the damage is already done from this one, but the ink isn't even dry on this bankruptcy, and they're already doing this again somewhere else. An internal investigation uncovered evidence that Link2 customers never owned the securities they thought they did. Link2, the once high-flying private stock investment platform, has filed for bankruptcy protection, citing investigations into its business and questions about what its customers even own. Link2 was one of the first to capitalize on small investors' hunger for the hottest private companies, including Elon Musk's SpaceX and artificial intelligence company Anthropic, and it became a test case for the risks to individual investors entering the lightly regulated market for pre-IPO shares. The platform grew to maintain about $500 million on behalf of thousands of investors around the world. Earlier this year, an internal investigation uncovered evidence that Link2 customers never owned the securities they thought they did, and that Link2 was marketing to some investors who might not have been eligible to buy private company shares, the Wall Street Journal reported. The Securities Exchange Commission and the Justice Department are looking into whether Link2 failed to adequately disclose its pricing practices to customers and whether its former CEO sold shares customers thought they owned without telling them. As a result of those violations and investigations, Link2 faced a fatal risk to its business and cannot continue to operate under existing conditions without restructuring, the company said in a press release. In other words, your money's gone. The only way forward is to seek court-supervised protection that will let us restructure the business into a profitable, law-abiding organization while resolving the ongoing regulatory investigations faster. Dan Siciliano, Link2's current CEO, said in a statement, when they're saying we need court-supervised protection in order to become a law-abiding organization, that means we are not currently or were not previously a law-abiding organization. In other words, that prior CEO, he stole your money, guys. That's what happened if you bought this stuff. Link2's customers are currently locked out of their accounts and are worried about when they will be able to access their investments or whether they will ever get their money back. Yeah, they probably won't. Now, look, guys, this is just happening this morning. This bankruptcy was just filed. And in a totally unrelated, having nothing to do with the LinkedIn story, parallel story, Robinhood is discussing tokenized equities with regulators. Again, what are the odds that these two stories would run on the same day? Robinhood Markets CEO Vlad Tenev said the firm is in talks with regulators over offering of tokenized equities in Europe after the launch drew rebuke from companies, including OpenAI. The Menlo Park, California-based firm announced last week to retail investors using its app in the European Union could start trading tokens that represent shares of U.S. equities on the blockchain. The launch included a giveaway of tokens for closely held companies like OpenAI. The firm led by Sam Altman later cautioned traders that the tokens are not equity in the company. They have some questions, said Tenev in an interview with Bloomberg Television, referring to Bank of Lithuania, which oversees Robinhood's activities in the EU. They want to make sure that everything is proper because it's a new, innovative offering. We're confident we think that these are not only important, but they'll withstand the highest form of scrutiny. If you have confidence in what Vlad Tenev is telling you here, that these are real shares of the company and that they're not just going to rob you and you're not going to end up just like the people who bought this crap on Link2, maybe ask some of the people who own shares of GameStop in 2021 what they think of Vlad Tenev's reassurance. The Bank of Lithuania told CNBC on Monday that it had sought clarification from Robinhood around the structure of the tokens. The central bank didn't respond to requests for comment on the inquiries. The tokens representing private stocks like OpenAI and SpaceX are not yet tradable, Tenev said. Since the companies aren't publicly traded, Robinhood values the businesses using its own internal methodology, according to a legal notice regarding the promotion. And what is that internal methodology? How is price discovery happening for shares that are not publicly traded? I don't know. Maybe they just have the magic 8-ball, number go up, number go down. And that's hey, it's proprietary, I'm sure. That's one way that they'll avoid having to look under the hood. So look, if you like what's happening at Link2, you're going to love what's happening at Robinhood. Meanwhile, we've got 2 injured and 2 missing in a new ship attack near Yemen's Hodeidah, Ambry says. Another ship has been attacked. Just yesterday, we talked about a ship that was attacked. Now we've got another one. It looks like this attack may actually be ongoing. 2 crew were injured and 2 others were missing on a Liberia-flagged bulk carrier that was attacked with skiffs and drones 49 nautical miles southwest of Yemen's Red Sea port of Hodeidah, British maritime security firm Ambry said on Monday. Ambry said the vessel's engines had reportedly been disabled and it had started to drift. It did not identify the ship. A maritime security source had told Reuters a vessel near Hodeidah was under a drone attack and had issued a mayday call. The vessel was later reported to be the Liberia-flagged Greek-operated bulk carrier Eternity Sea, which was attacked with sea drones and skiffs off the port of Hodeidah. Its manager, Cosmos Ship Management, told Reuters. 2 crew members were seriously wounded and 2 were missing, the company said, adding that armed security guards were on board. The vessel's bridge was hit, an official at Cosmos Ship said, adding that telecommunications had been impacted and contacting the crew was hard. Earlier in the day, Yemen's Iran-aligned Houthis said that the Magic Seas, a cargo ship they attacked with gunfire rockets and explosive-laden remote-controlled boats, had sunk in the Red Sea after their first known attack on the high seas this year. So Houthi and the Blowfish making a mess out of shipping again. Just a reminder, guys, that is another inflationary risk, ships being forced to sail all the way around the Horn of Africa, and that issue has not gone away. Now, one issue that has gone away, whether it should have or not, appears to be the Epstein story. You guys may have noticed over the last few days, we got word from the FBI that there was no client list, which is interesting because Pam Bondi said the client list was sitting on her desk a few months ago. Wonder where it went if it never existed to begin with in the first place. That's funny. And the FBI came out and said, we reviewed it and it turned out Epstein did kill himself. And shout out to the old man on Twitter who says it's at the old man is here, who said, I can't believe Epstein killed himself right before he was about to be acquitted due to a complete lack of evidence. How about that? What an unfortunate turn of events. Just goes to remind you guys, both parties talk a big game about this. Both parties had their names all over that freaking list. And that's why we haven't got it. That's why nobody's been prosecuted. 0.0 Epstein clients have been prosecuted. Not a single one. And now both parties are responsible for that, even though a lot of them campaigned on it. Just goes to show you different rules for the rich and powerful. And I just want to say thank you very much to Armando Reyes, who says, I'm having a calm before the storm feeling. Things are kind of quiet, if you ask me. I'm a little suspicious. Look, I'd use a lot of words to describe the world of finance and over the last few months. Quiet is not one of them, or I'd say the last few years. It's been anything but quiet. I think it feels quiet because we have been so desensitized to the noise. It's not that things have gotten quiet, Armando. It's that our hearing has been damaged by everything. I mean, since 2020, or I'd go back even further, since September of 2019, when the repo market blew up, it has just been one explosion after another in the financial world, wreaking such havoc on the lives of the average people. And, you've got this constant symphony of people saying everything is fine. Don't pay attention to the doomers. All is well. The problem is just bad vibes. Never mind the fact that cities are post-apocalyptic hellscapes and that people have taken a huge 20 to 30% cut in their standard of living over the last few years. And that, draws on 401ks due to financial hardship are on the rise and the labor market's weak. Never mind all of that. Everything is good, right? Just buy Cathie Wood's ARK Invest, which is really nothing more than an indicator of the M2 money supply at this point. Money supply go up, Cathie Wood does good. Money supply goes down, Cathie Wood do bad. That's basically all it is. So quiet, not the word I would use, not the word. But calm before the storm, or maybe storm before the storm, probably better. I don't know, but I don't particularly think it's quiet. Although, people think it's quiet again because stocks just keep going up. Everybody thinks that's prosperity. It ain't. Thanks, Armando, for supporting the channel. Madison Hype says, what does former Secretary Yellen think about the long bonds? We haven't talked to Janet in quite a while. But I think Secretary Yellen would probably say that she thinks it's awful funny that my predecessor, Secretary Bessent, is now doing exactly what I did. He's issuing nothing but Treasury bills because he finally got into office and took a look under the hood and realized there's no chance in hell that the U.S. government's going to be able to term out their debt. They're going to have to keep issuing Treasury bills in order to make up for the surging yields and lack of demand for long duration bonds. And everybody made fun of me for doing it, and now they're doing exactly the same thing. Well, Secretary Yellen, thank you again for the unusual candor that you put on display when you come on this channel. She's more honest here than she is anywhere else. So I feel like Janet and I have really established a strong rapport over the last few years. Honestly, I think Secretary Yellen is laughing all the way to the bank because right now she's just collecting on speaking fees like they all do, like Bessent will do when he gets out of office. But first, Bessent, before he goes on to collect speaking fees, he's got a pit stop to make at the Federal Reserve Chair. He's probably going to be the next Federal Reserve Chair, further blurring the lines between Treasury and Fed, if such a line ever existed. So, yeah, that's what I think the Madam Secretary has to say about the long bonds. Thank you, Madison, for supporting the channel. Robert Feeds the Machine says, good morning, Jack Stark. Yes, winter is coming in the crypto markets. You think fintechs will get big enough to repeat 19th century bank nonsense? Right now, they just seem to be a stupid tax. 19th century bank nonsense. I mean, there was a lot of there was panics in banks in the 1800s. Like every 7 or 8 years, there was some kind of bank panic or some kind of mayhem in markets. Honestly, I'd never drawn that conclusion. But what's happening in crypto, maybe not fintech, but in crypto, does kind of resemble that. Like every 4 to 5 years in crypto, you get one of these little panics. You get an FTX goes belly up, or a OneCoin, or a Mt. Gox hack, something like that. That's probably going to be MicroStrategy at some point. So that's a pretty interesting comparison. And by the way, note the improvement. It is a stupid tax, is what it is, because if you're buying fart coin, you deserve what's coming. Good luck to you. I'm okay with the stupid tax, to be honest with you. I would rather we have that. I would rather we have these brush fires that come along every 5 years and wipe out the reckless speculators than I would more government overreach that suppresses those brush fires, rewarding the crooks who run them. And then instead, every 10 to 20 years, we get a massive raging inferno that takes the responsible people down with it. So that's a pretty interesting comparison to the 19th century bank nonsense. I like that one. Again, I would clarify crypto versus fintechs. Although there's plenty to worry about in fintech, like with the buy now, pay later space. I think that's another issue altogether. But based on you making the Stark reference there, I'm assuming you were talking about my crypto winter is coming comment, which is why I tailored the answer to crypto. But thank you, Robert Feeds the Machine, for supporting the channel. Hey, Googly Eyes, thank you so much for gifting 10 Nobody Special Finance memberships. Welcome, you 10 new melon heads. Be sure and say thank you to Googly Eyes for supporting the channel with those memberships. And just a reminder, guys, if you are a Nobody Special Finance member, you get one free super chat a month. So feel free to use that, and I will read and respond to your question during the live stream. Thanks again, Googly Eyes. Break My Wallet Motorsport says, what would Janet say about the pending money printing in Great Britain? I would say, don't worry, Rachel. Here, take a tissue. You can use this to wipe away your tears. You're going to make stupid bank just as soon as you get out of your job. Just do what you want. Print whatever money they want, issue whatever bonds, practice yield curve control, do anything you can to keep this money train going. And then when you get out of your office, you can do what I do and get rich collecting speaking fees. And I think that's probably what Janet would say to Chancellor of the Exchequer, Rachel Reeves, who was very distraught over the prospect of losing her job because the politicians in the UK have no spine and couldn't even bring themselves to cut spending on welfare when 1 in 10 working age adults in the UK is on welfare. Let me say that again, because I feel like some of you probably didn't take the walk with me. 1 in 10 working age adults in the United Kingdom is on welfare. That's not a social safety net. That's universal basic income. Sorry, guys. All right. Thanks again, Break My Wallet Motorsports, for supporting the channel. Where was I? Here we go. Armando's back again. He says, if there's no list, why is Maxwell in jail? Well, Maxwell is in jail for running an international trafficking firm that had no clientele. Yeah, that's why. She's in jail for that. Guys, I don't want to get my channel in trouble by describing what she was doing. But yeah, clearly she had no clients, and that's why she's in jail. Ladies and gentlemen, the FBI, what can I tell you? Just get rid of. Why do we even have an FBI? Why do we even have them? Get rid of them. Thanks again, Armando, for supporting the channel. Lisa B says, a tip for the Yellen impression. Well, thank you very much, Lisa, for the tip. I appreciate that very much. Yeah, it's amazing how easy it is for a 6'1", 240-pound male to impersonate a 5'0" nothing, 100 nothing pound female. It's weird. It's the 2020s. What can I say? Thanks, Lisa, for supporting the channel. P-Nice has been a member for 11 months. He's dropping a couple of melon head emojis. Thank you very much, P-Nice, for supporting the channel. I appreciate that very much. And thank you, everybody, for having your coffee with the melon heads this morning. I appreciate that. Don't forget that like button and that subscribe button on the way out for the algorithm, should you feel so inclined. Also, should you feel so inclined, I've got links down below to Patreon and YouTube memberships. Thank you very much to my magnanimous melon heads who support the channel there. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.